The collapse of Silicon Valley Bank could have major impacts on the Federal Reserve going forward. This afternoon, our financial expert Paul Hood is here to discuss more about the bank collapse. This is still top of mind this week even. Well, let's start here, Paul. When we think about this bank collapse, it makes many people think back to 2008 and the situation that we were in then. What's different this time around?
Well, it's significantly different. 2008, you may have heard me say this before. Anytime the federal government or the government gets involved and they manipulate, they screw up free enterprise. So back in 2008, they created a system to where anybody could get a home loan. You were literally getting loans and you didn't have to put your Social Security number down, and you just were stated income. And then financial institutions packaged those mortgages up and made an investment out of them. Well, then when people started failing, interest rates started going up, people started failing, then the investments started failing, and there was this massive ripple effect. Today, what's going on is you've got a bank that was very flush with cash, that couldn't loan it out fast enough. And we've talked about before, when they bring deposits in, that's a liability. They have to pay, they have a cost to pay the interest to the people that deposit, and they make money by loaning that money out. Well, they couldn't loan it out fast enough, so they invested in treasury bonds. Then the federal government raised rates, and when you have a bond that has a rate that pays this much, and market rates are here, that bond sells at a loss. So all of a sudden, they have too much cash that's invested in a product that's showing a loss, and so therefore they had to report the loss. Then emotion gets involved and people ran on the banks. So it's really not a perpetual a thing that's across the country. It's very isolated, and so it's significantly different.
And that's important to keep in mind. You're going to continue to see headlines about this specific story, certainly as in the coming days, maybe even weeks. And what the federal government is learning now is that perhaps this was more of a mismanagement on that specific bank rather than something system-wide. So I think context is key, especially when we're talking.
Yeah, and what people don't understand is they think, oh, a bank failed, that means it doesn't have any money. This bank had money. They actually had too much money, which means they had too much interest they had to pay out, and they weren't bringing money in. Then the underlying investment showed a loss because of increased interest rates.
Now, what happened to SVB, could that have an impact on interest rates in general for all of us?
So it depends. You know, the Fed uses interest rates to manipulate the economy, speed it up, slow it down. So because of a bank failure, it doesn't necessarily mean that interest rates are going to be affected. Now, it could cause other banks to get a little more restrictive. That could cause, some internal decisions that could drive interest rates up, but it shouldn't. I think it's going to have more of an impact short term on the volatility of the stock market, especially since the federal government's basically said, nobody talk about this. Just let it try to blow over. And lack of information drives fear, which is what is driving the ups and downs in the stock market right now.
Well, looking at the stock market, I've always heard you're in it for the long game. The next few days, weeks could be a little nerve-wracking, of course. Yeah. But if you're in it for the long game, you're going to see it go back up. Yeah,
and the thing that I would tell people is what Warren Buffett says: be greedy when other people are fearful, fearful when other people are greedy. So what your emotions are telling you to do the opposite.
Always good advice. Paul, thanks for being here this afternoon. We're going to take a break. We'll be right back.